Hi, I'm Stuart Chamberlin, president of Chamberlin Financial in sunny Boca Raton, Florida. When I talk about financial defense with potential clients, I usually start by asking them this question. If you have a stock portfolio that loses 50% of its value, do you know what percentage you then have to regain in order to break even? Some people know the correct answer is 100%. A lot of them will automatically say 50% because that seems like the most obvious answer. Somehow they forget that if you start with $1 in the stock market and then you lose 50 cents, you have to double the remaining 50 cents to get back to $1. That doubling represents a 100% gain. If you earn only a 50% gain and then that 50 cents only gets back to 75 cents and you're still a little short. That's how the math really works. Now in the late 1990s, that question might have seemed irrelevant because people probably would have said, a 50% market drop? How likely is that? Well, it might not have seemed very likely during the best long-term secular bull market cycle our country has ever seen, but that all changed at the turn of the century. Since 2000, investors have actually gone through this scenario not once, but twice. The first drop started in 2000, and the market subsequently bottomed out in 2003, recovering in 2007, back to its previous peak. The second drop began in 2007 and bottomed out in 2009, fully recovering by 2014. Notice that in both cases, the drop took 7 years to get back near the previous peak. This represents two important questions. First, is it possible that this happens again? And second, how will it affect you personally if your investments are underwater for 7 years? Regarding the first question, think about this. Do you believe, generally speaking, that history tends to repeat itself more often than not? Most likely, you answer that question with a yes. The fact is, we have nearly 200 years of history that says there's a very high probability there will be another significant market drop around the corner. Regarding the second question, how will it affect you personally? Well, you can answer that. It might seem a little surprising that even investors whose portfolios were hurt by those enormous drops need to be reminded about the importance of financial defense and protecting their money. But it's often true, human nature is partly to blame. But the biggest reason is simply that defense isn't emphasized nearly enough in the financial industry. Most advisors don't talk about it much at all, and you certainly never hear it mentioned by brokers or the financial media. Unfortunately, that's because a lot of people in our industry are salesmen first, advisors and educators second. If you are a salesman, it's a lot easier to focus on the sexier, well-known strategies designed for capital gains rather than the lesser-known conservative tools designed to protect your downside and provide income. For salesmen, the stock market is the path of least resistance because it's the flashiest product and the one most people are already familiar with. Oh, and by the way, which kinds of investment tools and strategies do you think are designed to pay the highest fees and commissions? You got it. Oftentimes, it's the riskier ones. So, once again, salesman first, financial educator second. The fact is that most advisors end up being what I call Wall Street cheerleaders. They repeat the same cheers over and over again. Hang in there. The market always comes back. The market outperforms everything else over the long run. And ever popular, it's not about timing the market, it's about time in the market. Sound familiar? Let's face it, when is Wall Street likely to sell more of its products? When people are pessimistic about the markets or optimistic about the markets? The answer is obvious. That's why most of Wall Street's advisors end up being these Wall Street cheerleaders. It's easier and usually more profitable for them and for their companies to keep you fully invested in the stock market at all times. But unfortunately, it can also expose their clients' hard-earned savings to a lot of unreasonable and unnecessary risk. That's especially unfortunate for clients at or nearing retirement who, as a rule, don't usually have the means or the time to rebuild their savings by 100% when the market takes a nosedive. Remember, it took nearly 7 years each of the last 2 times the market dropped to recover. Don't forget that we also have nearly 200 years of history that says there is a very, very high likelihood there will be another significant drop around the corner. In my next video, I'll talk about market history and how I can say with such confidence that there's probably another major drop on the way, so don't miss it. In the meantime, think about Warren Buffett's 2 rules of investing, which is something I often share with my clients because it summarizes the importance of financial defense even better than I can. Rule number 1, never lose money. Rule number 2, never forget rule number 1. After all, who's going to argue with Warren Buffett? Certainly not me. I know we've covered a lot of information in this video. If you have any questions about anything I've covered, please do not hesitate to give us a call or send me an email, and we'll be happy to set up a free financial consultation to make sure you've done all you can to protect your wealth from the possibility of a major stock market downturn.